What's the story? AI stocks, crypto downturn, metals sell-off, SaaS spocalypse. Jim Bianco on Bankless. 76 minutes. The markets felt chaotic last week, so Bankless brought on Jim Bianco, a repeat guest and veteran macro strategist, to make sense of four massive stories that all collided at once. The SaaS apocalypse wiped $300 billion off global software stocks. Hyperscaler AI Capex forecasts hit $700 billion, up 60% from last year. Gold dropped 21% in 4 days, and silver dropped 50% in 7. Bitcoin fell 33% over 7 days to $60,000, and Ethereum crashed 42% to 1,750, making it the fourth worst day of the decade in crypto. Any one of these alone would be a bad day. All four at once left everyone confused. Section 1. The SaaS Apocalypse and the Collapse of Software Pricing. Jim started with his credentials. He subscribes to and actively uses the pro version of every major AI product, and he is deep into building agents. His take on the SaaS apocalypse was precise and illuminating. The issue is not that software is going away. It is that the pricing mechanism is under attack. Software as a service companies charge per seat because building software used to be enormously expensive. He gave the example of Google Chrome, which has 35 million lines of code, hundreds of engineers, and they fix 180 bugs a day. That represents hundreds of millions of dollars in investment. Now, an AI company called Cursor ran an experiment. They fed about 100 pages of prompts describing Chrome into their system, let it run for a week, and got 3 million lines of Rust code that produced a working browser. A bit buggy, not quite Chrome quality, but it cost about $150,000 in tokens. A year ago, building something comparable would have cost tens of millions and taken at least a year with 100 programmers. So the threat to Salesforce, Microsoft, and others is not that nobody needs CRM software. It is that a startup will raise some money, use AI to build what Salesforce has for a small fraction of the cost, walk in, and offer the same product at 10% of the price. The cost of producing software is collapsing toward zero, and that means every SaaS company's business model needs to change. Jim argued crypto fell into this same trap because crypto is fundamentally software, programmable money. If you overlay the S&P software index with Bitcoin or Ethereum, the chart looks remarkably similar. When the price of software collapsed in investor sentiment, crypto got swept up in it. Section 2. AI Capex, the infrastructure phase and when it all peaks. Jim's framework for understanding AI Capex spending draws from internet history. Every major technology goes through 2 phases. Phase 1 is infrastructure build. In 1999, that meant companies like Global Crossing laying fiber optic cable, JDS Uniphase, and Cisco, which was the largest market cap company in the world making routers. Everyone was playing the picks and shovels strategy. By March 2000, the infrastructure play got way overdone, and the Nasdaq fell 77% over 2 years. But as Jeff Bezos argued in an op-ed about 3 months ago, it was a good bubble because what was left was the internet. Phase 2 was the content and application companies that built business models on top of that infrastructure. Facebook, Uber, Google. That rally lasted 15 years. The overlay with AI is direct. We may be overdoing the infrastructure play right now. Google announced $200 billion in Capex for 2026. The Russian military budget is $165 billion. Google alone is spending more than the Russian army. But when the infrastructure phase peaks and the inevitable correction happens, we will be left with data centers running AI. Then the real value creation begins with the application layer, companies using AI to compete with incumbents at a fraction of the cost. As Jim put it, someone is going to say, I can give you the same thing Salesforce offers at 10% of the price. Why? Because my cost basis is nearly zero. Cisco peaked in 2000 and 26 years later still has not meaningfully exceeded that high. That is the risk NVIDIA faces. Whenever it peaks, that might be it for a generation. The app layer companies that will drive the next sustained rally either do not exist yet, are startups, or as Jim joked, are still in 7th grade gym class. Section 3. Gold, Silver, and the Asian Buying Frenzy. Jim provided a fascinating explanation of the precious metals chaos. Gold and silver are tiny relative to global stocks, bonds, and real estate. Last summer, they were about 3 to 4% the size. At their peak 2 weeks ago, 8 to 10%. It does not take a lot of money to move these markets, which is why Wall Street was scratching its head wondering who was buying. The answer, according to Jim, was Asia, primarily China. The Chinese economy is struggling with a terrible real estate problem, and Chinese investors are looking for places to hide. Japanese investors are worried too, because Japan's interest rates are surging. For the first time in 50 years, Japan has a higher inflation rate than the United States. There is an old Wall Street line that when interest rates go up fast and hard, something breaks, and that surge in Japan has not finished yet. Momentum followers in the US and Europe saw the rally, jumped on, and helped push silver to insane peaks around $110 to $125. But they were degens following the trend, not creating it. Now silver is back around 82, and all those momentum chasers are sitting with losses and do not know what to do. Jim drew an explicit parallel to crypto. Silver is the poor man's gold, an altcoin to gold's Bitcoin, with higher beta in both directions. On China specifically, Jim laid out his bearish case. During zero COVID, the government literally welded apartment doors shut. A fire broke out in one building, people could not escape, and many died. It sparked the white paper revolution. When those protests spread to the Foxconn iPhone factory floor, Chinese police beat the protesters and Foxconn was wiping up blood every day while continuing iPhone production. That put Tim Cook in an incredibly uncomfortable position and prompted Apple to start shifting production to India. Jimmy Lai was sentenced to 20 years in prison for criticizing the government. He is 78. China has manufacturing strengths, great open-source AI models, and massive energy production. But the political risk under Xi Jinping, who is becoming more authoritarian by the day, creates a hard ceiling on how much they can compete. Section 4. Crypto's third worst day and the synthetic Bitcoin problem. Bitcoin dropped from a high near 126,000 in October to 60,000, with no visible catastrophe to explain it. No FTX collapse, no Terra Luna, no COVID shutdown. Jim's explanation centers on what he calls synthetic Bitcoin. You cannot print more than 21 million Bitcoin on-chain, but off-chain, a fractional reserve system has been built around it. ETFs, structured products, options on ETFs, futures on options, total return swaps, convertible bonds on digital asset treasury companies like Strategy. Billions of dollars of people are playing crypto and never touching on-chain. These synthetic markets are inherently unstable, just like banking fractional reserve systems, which is why we needed to invent the Fed, the FDIC, the OCC, and the SEC over hundreds of years of blow-ups. Crypto's synthetic layer is new and does not have those guardrails. The real catalyst was not the centralized exchange derivatives that existed before, but the digital asset treasury companies and ETFs that created TradFi representations of crypto. Once you can put options, futures, and structured notes on those instruments, you get 3 or 4 levels removed from the actual on-chain asset. When the market cracked, the synthetic markets cracked first, pushing liquidation that showed up on-chain and drove prices lower. Jim compared it to 1987 when stock index futures, a new synthetic tool at the time, contributed to a 22% crash in a single day because the risks were not fully understood. The narrative that TradFi entering crypto would reduce volatility had a hidden assumption. It assumed TradFi would buy directly, either on-chain or one hop from on-chain. Instead, TradFi built multiple derivative layers on top, essentially being degens with suits and Bloomberg terminals. professional degens, as the hosts put it. Section 5. The replacement narrative and how crypto gets to $1 million Bitcoin. Jim's take on what comes next for crypto was one of the strongest segments. The adoption narrative that drove Bitcoin from 100,000 to 126,000 is over. Larry Fink gave permission, Jay Powell gave permission, Trump gave permission, the Genius Act passed. That story has played out. Crypto needs a new narrative, and Jim believes it should shift from permission to replacement. Instead of waiting for Larry Fink to tell you Bitcoin is going to $700,000, build systems that take BlackRock's business away. Instead of waiting for BlackRock to tokenize every asset, the crypto community should say we will do it ourselves. Larry, you better keep up. Every crypto winter ends with building. DeFi Summer in 2020 built a new kind of financial system and pulled the market out. Jim said he has been in this space for 9 to 10 years, and every time the space talks about replacing TradFi, count him in. When it stops talking about replacement and starts talking about being a casino, he gets nervous. That is exactly what he started hearing in summer 2025. He leans toward Ethereum over Bitcoin for this reason. If crypto returns to its bankless roots of building an alternate financial system rather than waiting for institutional permission, $1 million Bitcoin and $20,000 Ethereum are achievable. Section 6. New Fed Chair Kevin Warsh and the Future of Monetary Policy. Jim gave a nuanced analysis of incoming Fed Chair Kevin Warsh. The hawkish label everyone has stuck on Warsh comes from statements he made during the 2008 financial crisis, 20 years ago. He worried money printing would cause inflation. It did not. Jim argued that Warsh is probably not nearly as hawkish as the moniker suggests. More interesting is Warsh's push for a new Fed Treasury Accord. The original 1951 Accord drew lines between Treasury and Fed responsibilities. Warsh wants to update it because the Fed balance sheet, even after shrinking from $9 trillion to $6 trillion, is still too large. They cannot reduce it further without overnight funding markets getting volatile. Warsh's solution is to let Wall Street expand its funding markets to absorb the reduction, which requires Treasury cooperation. Jim also told a remarkable historical anecdote. In 1986, Paul Volcker was outvoted by the FOMC on a rate cut. He walked out and resigned on the spot. Within minutes, the other governors reconvened, reversed the vote, and Volcker unresigned. From that moment, the unwritten rule was that the chairman decides and everyone else salutes. But recently, FOMC members are starting to dissent independently. Jim thinks this is healthy. The old system where the chairman has all the power led to disasters like the transitory inflation call in 2021, when many Fed officials privately disagreed, but kept quiet. The practical implication: even if Warsh wants to aggressively cut rates as Trump wants, he may face 4 or 5 solid no votes on the committee. The Fed could start operating more like the Supreme Court, with genuine debates and public reasoning rather than rubber stamping the chairman's view. Section 7. Jim's Portfolio and the 456 Market. Jim closed with his investment outlook. On crypto, he is not adding to positions yet. He either wants to see real building toward TradFi replacement or a genuine capitulation event where ETF holders finally vomit up their positions. He noted that 92% of ETF money has not left, which sounds bullish but actually means we have not found the pain point yet. For traditional markets, Jim has argued for 2 years that investor expectations are unrealistic. The last 3 years the S&P returned 20, 25, and 17%. People now expect that as normal. His framework is what he calls the 4-5-6 market. Cash returns about 4%, bonds about 5%, stocks about 6 or 7%. Those are not bad numbers, but they sound bad when your expectation is 20% annually from just buying SPY and breathing. The big rotation underway is from tech and software into traditional value companies. The Russell 2000 and mid-cap stocks are rallying, because these companies spend heavily on legacy software and are about to get relief from cheaper AI-driven alternatives. Procter & Gamble, General Motors, and Exxon will be some of the biggest beneficiaries of the AI revolution because they are the users who get cheaper and better products. This was not on anyone's bingo card. The expectation was that when AI stocks peaked, they would take the whole market down. Instead, the other 50% of the market is swelling to offset the decline, keeping overall market value roughly unchanged. He closed with a cautionary story about a 72-year-old woman who called a personal finance podcast during the Liberation Day crash. Her biggest position was NVIDIA. She was weeks from mandatory IRA withdrawal, and between the market drop and tax bill, she lost half her net worth in a month. At that age and stage, she should have been in 3-month bills. Jim's message was clear. Adjust your risk to your age and circumstances, dial down your expectations, and the real AI opportunity in public markets is still coming. Key takeaways. The SaaS apocalypse is about pricing disruption, not software's death. The cost of building software is collapsing toward zero, threatening every per-seat subscription business model. AI Capex may be in an infrastructure overbuild phase similar to the dot-com era, but the aftermath will leave us with transformative technology and a massive application layer opportunity. Gold and silver's wild ride was driven by Asian buyers, particularly Chinese and Japanese investors worried about domestic economic problems, amplified by Western momentum followers. Crypto's crash was driven by synthetic derivatives in TradFi markets multiple levels removed from on-chain assets, creating unstable leverage that is new and poorly understood. The next crypto bull market requires a shift from permission-seeking to building systems that replace traditional finance. Fed Chair Warsh could usher in a more independent FOMC, where genuine debates replace chairman rubber stamping. And the big market rotation from tech into traditional value stocks is already underway, driven by the realization that the real winners of the AI revolution may be the companies using the technology rather than building it.